On YouTube, there are many videos of people sharing the great results they obtained by doing copy trading. They make it seem really easy. You just follow a bunch of people and you start making money instantly without knowing anything about trading. Sounds great, but is it? Hello, this is Manufactured, and if you're ready to discover the truth about money, you can stay here, otherwise you can go read your horoscope or something. Today I'll be explaining everything you need to know about copy trading. Copy trading, as the name suggests, consists of copying someone else's trades. If this person buys something, you buy. If this person sells something, you sell, and so on. It is usually done automatically with the help of some kind of platform that allows you to know who are the top traders and also allows you to follow them and mimic everything they do. The person that's being followed also receives some kind of compensation. At first sight, it sounds great. Without having to learn anything about trading, you should start following people who are already being successful, and you can reap the benefits of their knowledge and their experience without breaking a sweat. What could possibly go wrong? Well, many things could go wrong. First of all, who should you follow? Your first instinct will probably be to follow the top performers of whatever platform you're using. That is wrong for many reasons. The most obvious one is risk. Higher returns tend to be paired with higher risk, so you can't just look at the return on its own. You need to understand the risk of the strategy and bear it in mind when you pick someone to follow. Ideally, the traders that you're following should explain what are the strategies and what are the risks involved and for whom their strategy is suitable. However, if they fail to do this correctly, you might end up following someone that doesn't really have the level of risk that you need, especially if the strategy involves the use of derivatives. Derivatives can expose you to unlimited losses if they are not used correctly. Another reason why choosing the top performers is wrong is a known phenomenon called regression to the mean. In plain English, what this phenomenon says is that extraordinarily high returns do not tend to replicate themselves for too long. That is, extraordinary high return will very likely be followed by a more mediocre return. Following this rule, the traders that had the highest returns yesterday are not the ones that are most likely to have the highest returns tomorrow. If you're wondering whether this rule really applies to reality, it does. There's plenty of evidence that shows that outperforming the market is pretty hard, and outperforming the market consistently over many periods of time, it's even harder. For example, you can take a look at the SPIVA reports. The SPIVA reports study the returns of actively managed funds across multiple countries and across multiple asset classes, and essentially what they found was that most of them underperform their benchmark index. And these are professionally managed funds, not just random people trading on the internet. A very common tip for copy trading is to follow a bunch of different traders in order to diversify risk. Well, that's not how diversification works. In order to be truly diversified, you don't have to have just a bunch of different things. You also need those things to be negatively correlated with each other. That is, you need to have things that go up at the same time that all the things are going down, and that way your portfolio as a whole will have more smooth returns. If you just follow a bunch of different traders, you don't really have any way of telling whether their returns are going to be positively correlated or negatively correlated or what. And in fact, if you chose them all among the top performing ranking, chances are that they will be highly correlated. So as a conclusion, there's no real way of telling who you should follow. But that's not the only problem. Another big problem is ethics and conflict of interest. Even if you somehow stumble upon the next Warren Buffett or the next Peter Lynch, whatever, how do you know that this person is going to behave ethically? Trading is a sum-zero game. For everything that you need to sell, there has to be someone buying it and vice versa. So every dollar that you make trading is a dollar that someone else is losing. There's not a lot of room for cooperation in trading, and in order to be a successful trader, you need to be very good at spotting every little opportunity that the market offers you to make a profit. And unfortunately, the knowledge that there will be a bunch of people replicating everything that you do poses an advantage for the person that is being followed. That's why financial advisors, portfolio managers, and brokers in most countries need to comply with lots of regulations, and they also have to abide by a code of conduct. With copy trading, the people that you will be following is just random people trading on the internet. Collective 2, for example, it's a platform that offers the possibility to implement automatic investment strategies that are developed by other people. They say in their website. Strategies are developed by quants or traders or weird geeks in their parents' basement. As far as I know, the weird geeks in their parents' basement don't have such a thing as a code of conduct. Again, whether the person that you're following is the next Warren Buffett or the next Bernie Madoff, there is no way to tell. Just by looking at their profile picture, their bio, their track record, you can't really tell if the person is going to behave ethically or not. Finally, the biggest problem with copy trading is the lack of accountability. Let me explain with an analogy. Let's say that, for example, you want to try skydiving. How would you approach that? Would you try to find a serious company with qualified instructors, a company that complies with all the regulations and all the safety measures and etc.? Or you would just hop on a plane with a random stranger that you met in the internet and copy everything he does? Trading is not that different from skydiving. They are both very risky activities that may lose you something very important to you. In the case of trading, well, your hard-earned money. You shouldn't trust your health and your life to random strangers that you meet in the internet, and you shouldn't do the same with your money either. When you automatically or blindlessly copy someone else's trading, you are essentially giving that person control of your account. That violates a very important principle that says that control and accountability should always go hand in hand. You should never be accountable for something that you can't control, and conversely, you should never give someone control of something if you can't make that person accountable. With copy trading, accountability is non-existent. If the people you are following fail to implement their strategy correctly, or they fail to communicate it properly, or they just plainly scam you, there's not much that you can do. You can only insult them on social media, and that's it. Moreover, some of the platforms that offer this service specifically state that they are not licensed financial advisors or licensed portfolio managers. There are other platforms that are licensed. For example, eToro says that it's licensed as a portfolio manager. However, we don't really know whether the people that you are going to be following have these licenses or not. If something goes wrong, you don't know if you can claim or not, and you don't know whether the person you're following or the platform you're using will have assets. For the moment, I don't really like this tool, even though it's pretty innovative, I have to say. And of course, the fact that it introduces more competition in the field is always good. From the point of view of the trader that is being copied, I think that this tool is really helpful and it makes sense. If you want to get started in portfolio management or financial advice and you don't want to go through all the bureaucracy of getting the licenses, well, starting this way, it's way easier and quicker. However, the problem is that from the investor point of view, I think it leaves the investor way too unprotected. So overall, I wouldn't recommend it. If you're a beginner investor and you don't want to do a lot of work, I think that there are other tools that you could consider. For example, next week's video, I'm going to be discussing index funds and all the evidence behind them. See you there. Bye bye.